Good afternoon, everybody, and welcome to another edition of SRT Live. We are on it today. We had a monstrous week last week, and I apologize. My systems are bugging out on me. Hang tight, hang tight. Ta-da. I think there we go. All right. So the economy has been sending mixed messages. So what direction are we actually headed in? We're going to talk about that today through the eyes of the information that we got last week and what to look ahead for this week and a little sneak peek into the future beyond that as well. So again, welcome to SRT Live. I am your host, Sean, with the Sean Richard Mortgage team, and let's get this party started. All right. So let's look at last week in review. And man, did we get an immense amount of economic and housing data last week. Let's start with one of the big key recessionary indicators. We got Q3 GDP. Now, this is the second reading. So every quarter, we get 3 readings for GDP. The month after the quarter ends is reading 1, and then the next month 2, 3. So we got the second reading for Q3 GDP, and it came in above expectations. If you recall, the first reading of GDP for Q3 was at a growth rate for our country at 2.6%, and we came in at 2.9% on this reading, so showing a little bit further growth. So this signal tells us, or this message says, oh, we're growing as an economy. We're expanding at 2.9%. Now, in the grand scheme of things, we've got inflation running hotter than that. So the expansion at 2.9% still not astounding. And we also got pending home sales. Now, this measures signed contracts on existing homes. Now, this was down 4.6% month over month. But this was in relation to the expected negative 5.5% or 5.5% decline from market economists and market analysts. So we improved from what the analyst. Wow, I can talk today. We improved from what the analysts were looking for. Now we are down 37% year over year on pending home sales. But remember, we've got a lot that have changed year over year. We've seen home prices continue to rise up until very recently. We've also seen interest rates rise dramatically over the last 12 months, and that's caused the speed or pace of homes to slow down as well. So we can expect to see that down on a year over year basis. And the fact that we beat analyst expectations for the month is a positive sign for the housing market. Just more information that points to the housing market is staying strong, although we are receding from some of our really hot numbers that we've seen over the last several months or earlier this year. Let's see. We also got the JOLTS report. Now, this is job openings across the country, and this was a big miss. So the previous month, there was 10.7 million job openings, and that fell to 10.3 million. So a big dip, 400,000 job openings came off the table. And that could be a number of reasons. A big part of that very well could be a lot of employers are starting to slow down on hiring. They're taking job openings off the table. So that is a big part of what's happening in that market. We want to continue to see the trend in job openings. If that continues to decline over time as we roll into a potential recession. As always, last week on Thursday, we got the jobless claims. This is unemployment claims, and we get initial claims and we get continuing claims. Initial claims is individuals filing for unemployment for the first time, and this is a weekly reading. So for the prior week, we got a reading of 225,000 new jobless claims. This was a little bit lower than expectations of 235,000 and a healthy amount lower than the prior week's reading of 241,000. So we're seeing very mixed signals in the economy. We're seeing GDP up at 2.9 from the expected 2.6, but then we're seeing unemployment claims come down, and we're seeing job openings decline. So we're seeing some very, very mixed messages in the economy. So we're trying to figure out and read through all of these signals to figure out what direction are we really going? Is the economy fine and we're just kind of chugging along until we can start really strengthening again, or are we truly heading down a slope towards recession? Now, continuing claims, we saw the exact opposite. We saw a 50,000 job unemployment claim increase on renewing claims. Again, continuing as individuals renewing their unemployment claims. So we went from the previous reading of 1.55 million all the way up to 1.60 million claims renewed. So again, initial and continuing claims telling a little bit different stories with the direction that they're moving. Now, if that wasn't enough for last week, we also got inflation data in the PCE report. This is the personal consumption expenditure. This measures inflation via a basket of goods. Now, this is the headline number, which includes energy, food and energy. Now, the Fed likes the core PCE, personal consumption expenditure, because that strips out food and energy because they feel that they have less control over food and energy costs. So this came in at a 0.3% increase month over month inflation reading. This was a little bit lower than expectations of 0.5%, but right in line with the previous month's reading at 0.3%. And year over year numbers came in at 6%, just a tad lower than the 6.2% estimate. Now, this is the headline number, and the Fed is looking to get the year over year core number down to around 2%. Right now, that's sitting closer to 5 to 5.5%. So we've still got quite a ways to go on an inflationary standpoint to get where the Fed wants to see us. That's their target is 2% inflation at the core level year over year. The highs on the headline number for PCE was up in the 7s. So we have seen inflation taper off some since it peaked in June, July. So that's really, really good news as we head into the latter part of the year. All right. We also got BLS Jobs Report last week. This is the number of jobs created across the country last month, and this was 263,000 new jobs created. Now, what's interesting about this number is that there's two components to the labor numbers when the jobs report come out. We have the business survey, which really makes up the Board of Labor and Statistics jobs report, job creations. But then there's the household survey, which really flows into unemployment rate. And the business survey, which showed 263,000 new jobs created, really told a different story than the household survey, which showed a loss of about 120,000 jobs month over month. So very interesting. Again, it's a tale of two stories. We're seeing some very positive numbers on one end with the business survey showing 263,000 new jobs created versus the household survey showing about 120,000 jobs lost. So the question then becomes is where are these job creations coming from? Are they simply from individuals having to work multiple jobs to combat inflation to bring enough income into their household? These are all questions that we can start to see answered as we look at trends through the end of this year and into the beginning of 2023. All right. So unemployment, since that's part of the labor force, is unemployment held steady at 3.7%, but we are up from our lows of 3.4, 3.5%. So if we start to see unemployment tick up over the next several months, that very well could be a great indicator. I say great loosely, great indicator that we are in fact heading into recession. Last week, we also heard from Jerome Powell. We literally got all the data that we could possibly ever want last week. We heard from Jerome Powell, and the big piece of information that I want to extract from what he said was, he said that December may be the right timing to take the foot off of the gas when it comes to quantitative tightening or increasing the Fed funds rate at the speed that it has been. If you recall, we've seen numerous straight 0.75% increase to the Fed funds rate, and that has pushed the cost of goods and services higher on things like consumer loans, consumer credit cards, auto loans. All of those items, among others, are dependent on that Fed funds rate, and pricing is dependent on that. But they're doing this to combat inflation. And so as we see this filter into the economy, then we should see inflation continue to subside, which, if you're a home buyer or a home owner or a real estate agent, that will help bring interest rates down. And we've already seen a little bit of that happen. We saw interest rates dive about 0.5% a few weeks ago when we got the previous CPI, or Consumer Price Index report. All right, that was last week, folks. This week, not a lot of data so far this week, but we do have a couple of key things coming out later this week. On Thursday, as always, we get our jobless claims, initial and continuing, and then Friday, really big one, we get PPI, which is Producer Price Index, which this is inflation at the wholesale level. So there's 3 inflation reports that we get on a monthly basis. We get CPI, which is Consumer Price Index, inflation at the consumer level. We get PPI, Producer Price Index, which is inflation at the producer level. And then we get PCE, Personal Consumption Expenditure, which is the Fed's favorite measure of inflation. Measures inflation slightly different way than CPI does. And so we get PPI on Friday, and that is a great precursor to our next CPI reading, since the inflation at the wholesale level does not always get passed through to the consumer, so it doesn't always show up in that CPI report. But if we start to see inflation come down on the PPI report, there is a high likelihood that we're going to see that filter through into future CPI inflation reports. All right, so what are we watching going forward? And really, it's all about inflation right now. Inflation is driving the bus in so many aspects of our economy. It's keeping mortgage interest rates high. It's driving the price of goods and services up, which is hindering the consumer. So we're watching inflation and watching it closely. So when it comes to inflation, we've got the next CPI report coming out on December 13th. And the timing of that is pretty significant because the Fed will be holding their December meeting on December 13th and 14th. So we're going to get one more inflation reading before the Fed determines what their next Fed funds change will be. Now, according to some inside media, as well as economists, we're expecting the Fed to increase the Fed funds rate by another 0.5% come December 13th and 14th. That's going to put more pressure on those consumer lending products, auto loans, credit cards, things like that. Now, note that, and I've said this before, if you've been paying attention, you know this, but the Fed funds rate does not have a direct impact on mortgage rates. Again, the Fed increasing the Fed funds rate is designed to combat inflation. And as inflation comes down, the mortgage rates will subside as well. Now, I want to show you one thing before we get going, because I want to talk about money supply. So at the core of it, inflation is too many dollars chasing too few products and services. So if we look at the money supply in our country, that's going to tell us a really good story about how many dollars are circulating. And with the supply chain constraints that we know we've seen over the last year due to the pandemic, we know that we've had way too many dollars in the marketplace with all of the stimulus that has been done at the federal level. So let me show this to you. Check this out. Here we go. So this is here. Let me take this off for us. Boom. All right. So we've got the rolling 7-month change on the money supply dating all the way back to 1959. So take a look at this. Money supply change. Here we go. Here we go. Spiked up to, look at this, March of 21. This is probably, if we were to be able to draw an exact line, this would probably show us 2020. With all the stimulus that we had post-pandemic, or part of the pandemic, the money supply in our country jumped dramatically. And so we had excessive supply of money. but we had an extreme shortage in goods and services. So again, too many dollars chasing too few goods and services, and that drives inflation up. So we've seen the money supply drop dramatically since the peak of the pandemic. And so what we end up with is we end up looking at the change year over year or year to, throughout the year. What is the oddity that you notice on this chart? Let's take a look right here. 2022, we are on pace, and we've only got a few weeks left in December. We are on pace to have the first negative monetary US money supply change since 1959. We'll call it 1960 since we don't have a change actually in 1959. So imagine that. So what's that? 62 years we've seen positive money supply increasing. Now, not all of them were dramatic, but we're on pace to have the first decrease in money supply year over year since 1960. And so we're seeing the money supply come down, and supply levels are, for the most part, they're relatively static. We could hopefully start to see them improve as supply chain constraints ease. And so as the money supply dries up and supply chain issues improve, we're going to see inflation come down. So we've got a lot of signs, a lot of data that show us that we are likely going to see inflation decline in the not too distant future. And again, home buyers, realtors, realtors, have this conversation with your home buyers, show them the data, screenshot the information, have them reach out to my team. Right there, leave comments below. Talk to your buyers about this information. Home buyers, this is important for you because this lets you know that some relief is on the horizon. And if you do buy right now and have the benefit of starting to build that equity, then 6, 12, 24 months from now, when the rate environment likely does decline, we're going to have an opportunity to refinance to a lower rate without having given up the equity build process between now and then. So really, really important as we look at the health of the real estate market going into 2023. I think we're going to see a very robust real estate market in the late spring and into the summer of 2023. So agents, get ready. Home buyers, be ready. You might have to battle for some homes again as those interest rates come down. All right. Everybody, I want to say thank you so much for joining me on today's episode of SRT Live. If you are watching in the Powerhouse Real Estate Facebook group, thank you so much for being an amazing part of our community. If you're checking us out on the Powerhouse YouTube channel, be sure to smash that subscribe button so that way you can get up-to-date real estate and economic information at the palm of your hand. All right, well, have an incredible rest of your Tuesday, and I'll be back next week with another amazing update. Take care.